Yeah, good morning, everyone. This is Mr. Kimbode, the King of Waves, the lead analyst at Potential Miners International, a platform dedicated to research and development. Our focus is to engage or leverage on the strength of research to be able to identify areas of potentials that we can harness both at individual level and at corporate level or even government level. So today, just like our usual practice, this is a recorded video. We were supposed to be having a live session where we are going to analyze the market, but our system, the internet is not really permitting that. So today, we decided to record this session so that we can as well analyze the market together for the week to know what and what assets should we be looking into to position for a trade for the week. So without further ado, I'm going to launch straight into the first phase of our analysis, which is the fundamental analysis. And when we say fundamental analysis, what we are trying to do is to look at how the economic stance of different currencies or different economies, you know, is positioning their currencies for demand and for supply. And we have narrowed down the focus of our fundamental analysis at Potential Miners International to the interest rate divergence. We want to look at the interest rate standpoint of different currencies. Then we look at, do we have any event for the week that can change the stance of the interest rate? Then we will now look at, if we pair different currencies or two currencies, what is the divergence of interest rate, between these currencies? And that is going to really help us to identify pairs of currencies that we might need to, focus on from the fundamental standpoint. Then we'll now move to the sentiment analysis, where we optimize some of these pairs, and we'll now see what we can have in terms of capital flow. Then we can now move to the technical analysis, which will now definitely be our the last phase of our analysis, the technical analysis, where we look at where we can position for the market for initiation or initiating a particular trade, for the week. So having said all of that, today we just want to quickly look at the interest rate, just like our usual practice. So we want to go to forexfactory.com, and we want to look at the interest rate. The central bank rate is always at this side of the site. So once you get to forexfactory.com, you click on calendar. Once you get there, suppose you are just getting there now, you click on calendar, it will reload. Then you scroll up, then you'll be looking at the left side of the site. Then that's where you will see the interest rate for each of the economies. So when we say Australian dollar, what we mean is the interest rate for Australia as a country. Then when we say GBP, the interest rate is so. What we are saying is that for the Great Britain, the interest rate is 3.75, for instance. So don't be carried away to say that when we talk of interest rate, we are just looking at the currencies. This is important so that you can understand that analyzing the fundamental standpoint of a particular currencies is that you are analyzing the economy of that particular currency. So we have different economic indicators that narrow down to the interest rate decision. We have indicators like the gross domestic product. We have indicators like the inflation rate. We have indicators like the employment data, unemployment rate, retail sales, and all of different sentiment indicators, all of which, from our analysis over the 6 years, we have seen that this data set or these economic indicators, they are what sum up to for the decision makers when it comes to interest rate position. What do I mean by that? These are the indicators that the central bank of each of these economies they analyze, and because they have mandate, to ensure stability of price in the market, ensure full employment, for example, they ensure that they look at each of these data sets as they are made available, whether on month basis, quarter on quarter basis, or year on year basis, and they analyze all these indicators, and they now decide what is the interest rate that will be best fit for this economy, so that we can be able to stabilize the price and still be able to ensure that we keep the employment level at the appropriate standpoint or position. So for us at Potential Miners International, we believe that the interest rate is telling us the full story of the standpoint of the economy, when it comes to other indicators like the output, like the employment rate, like the employment figure, like the inflation rate. So having said all of that, when you say you pick a particular currency, for instance, you pick Australian dollar, and you say the interest rate is 3.85, you can take that interest rate position and relate it with another currency, so that you'll be able to know on a particular on a long term, or from a fundamental standpoint, where will capital be flowing into. Because like I've said over and over again, forex market is a game of interest rate. This is how professional traders view the market. Forex market is a game of interest rate. So you want to look at the interest rate. You start your analysis from overviewing the position of the interest rate at any point in time. And just like we just overview, you can see on the site we have Australian dollar 3.85, which happens to be the highest interest rate. We have the GBP 3.75, US dollar 3.75, Canadian dollar 2.25, New Zealand dollar 2.25, Euro 2.15, Japanese yen 0.75, and Swiss franc is 0.0, just like we see it here. What is this telling us? This is telling us that given the fact that we trade in the forex market looking at pairs of currencies, if you want to really be able to pair a currency and to be able to establish or see trend in the market, you are expected to pair currencies with a very wide interest rate divergence. Let me say that again. Because we are expected to follow the trend, if you really want to enjoy the forex trading, you are expected to follow the trend. Now, one of the things that will guarantee that you have a clear trend on a particular currency pair is that the currency pair should have a relatively large divergence when it comes to the interest rate differences. Let me give you an instance. If you are asked to trade AUD JPY, or you are asked to trade let's say CAD NZD, based on our fundamental investigation or analysis, we notice that over time, currencies with a very wide interest rate divergence, they maintain a steady direction or trend. Because this is showing clearly that if there is a template of risk on in the market, predominantly there's going to be activity of the carry trade. Investors will like to borrow money from countries with a very low interest rate, and they would like to invest that particular money into a country with a very high interest rate, and that is what we call carry trade. You see, that carry trade is going to ensure that capital will be flowing away from a particular currency, especially the one with very low interest rate, into a particular currency, the one with high interest rate. So if you pair these two currencies together, for instance, the AUD JPY, there is high tendency that you have a clear trend on that particular currency, relative to when you, or compared to when you now pair CAD NZD. You see it now. So from the standpoint of the interest rate, the most important thing is to look at the interest rate. Then you pick interest rates, you pick currency pairs, I mean to say, that has, you know, a relatively large interest rate divergence. So for us at Potential Miners International, if we are going to be trading, of course, this is the first phase of our analysis, but let's say we just want to trade based on the interest rate divergence alone. We are going to consider currency pairs like AUD JPY, GBP JPY, USD JPY. And we are going to be expecting that these currency pair will give us a predominant buy. Why? Because the divergence of the interest rate is in favor of AUD, GBP, and USD as compared to the JPY. Do you see that now? But because a lot of other events affect the market, a lot of other happenings that are not economic. You see, fundamental analysis is predominantly on economic data. But we have other factors that can shift the movement of currency pairs in the market. You know, we have the geopolitical stance. You have policies also, you know, comparing trade or tariff position, you know, between trading countries. No, these are other. We have natural disasters that can shift the template of capital flow in the market. Because of that, it will not be professional for us to limit our analysis to just the interest rate divergence. And that is why we ensure that at Potential Miners International, after our fundamental analysis, where we identify currencies that has likely for a high likelihood of having a clear trend, we are now going to move into the sentiment analysis, where we optimize our choice of currency pairs. And that is what I want to do right about now. So when it comes to the sentiment analysis, we have 5 different indices that we look into, and I'm going to run through them right about now. If you have been following us on this channel, you must have heard me say that the sentiment of the market is the template of capital flow. The sentiment of the market is what depicts at every point in time where capital will be flowing into or capital will be flowing out of predominantly. I want you to underline that word, predominantly. So you want to really take note of the sentiment of the market at any point in time. And we have 4 different sentiments. We have the risk on, we have the risk off, we have the risk on dollar aversion, and we have the risk off dollar aversion. And of course, at every point in time, you are expected to overview the indices that we have been able to come up with after our 6 years of research. Overview these indices. Let's see what is the conclusion of the risk sentiment of the market. Then you can now move into the technical analysis. That is when you can get to the technical analysis, then you can now begin to take position with a level of confidence. You see it now. So let's quickly do the sentiment analysis so that this video is not going to be too long. The sentiment analysis, now we start with the S&P 500. What is the position of S&P 500? This is very important for us to know, because the position of S&P 500 is telling us to what degree are the investors ready to put their money into investment, into risk. That is what S&P 500 and some of these indices will be telling us. You know, the stock market, if we pick the top 500 performing, companies in the United States, let's look at the movement when we index it. Movement of all their stock combined over time. What is it? Is it buying? If it's buying, it means a lot of investors, they are ready to risk their money. And that is why we pick S&P 500 to start with. Then what do? We want to expect that if there is a level of risk tone in the market, the S&P 500 index will be on a bull structure or bullish structure, as the case may be. So what that means is that if you have this gauge, just like If you are seeing this video for the first time, this gauge is PMI centered. This is one of the discoveries of our 6 years of research. This particular gauge is the directional bias gauge. If you don't have the settings, you might need to reach out to us in the comment section. We are going to send it to you. It's free. What this gauge does is that it tells us, it helps us to look at the market very easily when it comes to the direction. Then the second tool that we use is the market structure tool. This market structure tool tells us the predominant structure of the market at any point in time. And these are the two tools that we engage to make our analysis so easy and out of emotion. You don't want to include emotion in your analysis. So these two they will show us what is happening in the market at any point in time. So when we get to the analysis of the indices, to know the level of risk in the market or the movement of the stock indices or stock index, as the case may be, we want to engage the directional bias tool and the market structure tool. So once you plug these two tools on your chart or your charting platform, it's going to be obvious if you have a predominantly bullish structure. Can you see? You will notice that the price is still above the cloud and the structure is predominantly bullish. The structure is predominantly bullish. So, given that the S&P 500 index is still above the cloud, is a confirmation that to a large extent, investors, they are still ready to put their money on the line, which means we have a risk on template of sentiment in the market. But we don't want to rely on just one index. That is why we have been able to look out for other indices or index that we can use to validate our position at any point in time. So for the stock market indices, we have 3 indices. Then we have the fear index and the dollar index. So let's look at the next index that we use. I told you that we have 5 of these indices and that we overview at any point in time. If you must overview these indices, you have to put your chart on the daily time frame. Put your chart on the daily time frame. That is the best way, chart time frame, that where you can view the structure of the market, the predominant structure and tide of the market at any point in time. So the Nasdaq Composite Index is showing that the price is below the cloud and that the structure is becoming bearish. Note, the particular Nasdaq Composite Index show that before now the price has been predominantly bullish, but right about now, today 24th of February 2026, there is a change of the structure on the Nasdaq Composite Index, telling us that we have a ton of risk of coming into the Nasdaq Composite Index. Now let's move to the next index. We are now going to confirm what are we going to follow. Are we going to follow the S&P 500 or the Nasdaq Composite Index? And the next index that we are going to be focusing on is the Dow Jones Industrial Average Index. Anytime you have 2 of these indices saying the same thing, you want to follow whatever decision you have on them. What do I mean by that? We have 3 indices for the stock market. So if one of these indices is telling us that there is a bearish structure and 2 of these indices is still showing us that we are still on a bullish structure, we want to still maintain that bullish structure. The one that is telling us that there is a bearish structure is only telling us that the movement of the stock market can change anytime from now if nothing changes, or if the reality continues, if the risk tone of the market is being disrupted just as it's been disrupted, the tone can change from what we used to have to the opposite. But what are you to conclude on? You don't want to imagine for the market. you want to still wait and allow two of these indices to be saying the same thing. So in this case now, we are still going to maintain that since S&P 500 is still above the cloud and is predominantly bullish, and the Dow Jones Industrial Average Index is still above the cloud and is predominantly bullish, we are still going to conclude that based on the stock market indices, we still have a risk on in the market. Now, what this particular Nasdaq composite is telling us is that we should be very cautious. Now, are you getting it now? But our conclusion is still that we have a risk on template in the market. So the next thing we want to look at is our VIX, the volatility index of S&P 500. How volatile is this index is going to tell us whether there is fear in the market, or there is stability in the market, or there is panic. When you have this index above 20, it's telling us that there is a level of fear in the market, and you will notice that this particular index is around 21 now. You see it now, and this is reflecting what the Nasdaq Composite Index is suggesting. Are you getting it now? But because the stock market, based on the S&P 500 and the Dow Jones Industrial Average, is still telling us that there is a predominant, we are talking of predominance now. Which one is more effective? That is what we are saying. So predominantly, we still want to maintain that there is a risk on based on the stock market indices. Now, when you get to the volatility index, this particular index will tell you the more the index move away from 20 to the upside, the higher the fear in the market. So if the index is still around 20, 21, quite right, it has moved above the threshold. The 20 is the threshold. But if it's still 21, it can still move below 20 within 4 hours. You see it now. Let me just use this as an example. The market move above 21 here, and within the next 4 hours, you see it move down to 18. So when you still have the volatility index around 20, 21, 22, and the stock market indices is not telling you that all the index are below the cloud, you still want to maintain that, although there is a tendency for fear to come into the market, but as of now, the template is risk on. Are you getting it now? So let's move to dollar index, which is going to be the last index we are going to look into before we now go into different assets to analyze. I hope you are getting the way we analyze at Potential Miners International. So when we get to the dollar index, we want to ensure that if dollar index is below the cloud, it means there is predominant of dollar aversion. You don't want to argue with this, and you cannot shy away from the position of the dollar in the market. Dollar is the king. Dollar index is showing us the position of dollar when you compare it with other currencies in the market, especially the 8 major currencies, the remaining 7 major currencies. So if dollar index is below the cloud, the conclusion will be that there is still a predominant level of dollar aversion. Are you getting it now? So we are still expecting that if the dollar index stay below this cloud, that dollar will still continue to lose its value. At the moment, it might look as if dollar is gaining value, but the expectation is that because this particular index is below the cloud, there is a level of dollar aversion in the market, and our own decision will be based on that. If this particular in the index now move above the cloud, we can now say, okay, there is no longer dollar aversion. Then that is when you will see dollar pumping to the upside. Are you getting it now? And of course, this will be dependent on the fundamental position of the interest rate of the United States at any point in time. So having said this, what is now our conclusion? Our global macro evaluation concludes that for today, 24th of February 2026, the risk sentiment of the market is risk on dollar aversion. Let me say that again. Our global macro evaluation of the forex market as at today, 24th of February 2026, says that the risk sentiment of the market is risk on dollar aversion. Having said that, we can now begin to pick currency pairs to see how we can now position, and that is what will move us into the technical analysis. You can see that we have done the fundamental analysis. We move from the fundamental analysis where we did the identification protocol to the sentiment analysis where we did optimization protocol. Then we now move to the technical analysis where we are going to do initiation of trades. So having said that, let's just pick few currency or assets, then we will analyze together. The first asset I would like to analyze, I want to believe an average trader should be trading gold. So an average trader should be trading gold. Let's see. I'm going to analyze gold now. You will remember last week, if you are privileged to listen to our analysis for last week, you remember that I said that gold, we are expecting gold to buy. And why are we expecting gold to buy? Because the risk sentiment of last week was also risk on dollar aversion. So we are expecting gold to buy. We expected gold to buy. And I said that you are not going to do anything on gold until gold break above 5,120. And into this week now, the market opened yesterday on Sunday. Stroke yesterday, the market broke above 5,120. So we can now position for a buy on gold for this week. Let me say this again. Based on our projection of last week, the market for gold is just doing as expected. So the market has broken above 5,120. And it has created a change of character on the daily. A change of character on the daily. So for gold, what are we expecting for the week? We are expecting a buy. Why? Because the sentiment of the market, or the risk sentiment overview of the market, is risk on dollar aversion. Risk on dollar aversion. Not even minding the fact that we have an element of fear in the market, showing in the volatility of that is above 20, that is 21, hovering between 21, 18, 19, 21, 18, 19, 20. You see it now. But based on the risk sentiment conclusion, risk on dollar aversion means that because gold is paired with the dollar, we expect that gold will buy if the tone of the market is risk on dollar aversion. So having said all of that, we quickly look at, for our technical analysis, we have conditions that we look into. The first thing we do is, let's see what is the directional bias. Directional bias is the first, is after we have picked a particular asset, the next condition is directional bias. Condition number one is you want to pick your asset based on the global macro evaluation. And we have been able to do that. So we have gotten to gold now. We pick gold as an asset to trade from our global macro evaluation. So the next thing we do is to check what is the directional bias, and we do that on the weekly chart. I want you to follow closely how we analyze the market at Potential Miners International. I'm saying this for those that could not afford to connect with us to learn, from the platform yet, but you really want to know what we do. So the first thing is to evaluate the market based on global macro overview, to check what is the fundamental standpoint, check the sentiment of the market, then you select asset to trade. Then the next thing is you want to look at what is the directional bias, and we look at the directional bias on the weekly. So once the price is above the cloud, this is the cloud now. You see, this is the cloud. Once the price is above the cloud on the weekly, is a bi-directional bias, we are not going to be selling. This means that suppose you have been following potential miners since 2023, would have still been taking a buy on gold since 2023. Why? Because the directional bias says we should buy. So anytime we have the price above the cloud on the weekly, we are only going to be buying. And of course, the reverse is the case. Once we have the price below the cloud on the weekly, we are going to be selling. You see it now. So that is the second condition. The third condition, you want to look at what is the orientation of the market, and we want to do that on the monthly chart. What is the orientation of the market? You go to your monthly chart to say, what is the orientation of my market? Let's see what we have. The orientation of the market can either be a markup, which is an uptrend, a markdown, which is a downtrend, a consolidation, or an accumulation. You see it now. So once you get to the monthly chart, I beg your pardon, you want to look at the market from the monthly chart or on the monthly chart. Do you have a bullish trend, an upward trend, or a downward trend? If it's an upward trend, it means the orientation of the market is a mark up. You might need to search some of I've done videos on different on all these concepts on our channel. You might need to search for it, market orientation, and listen to it. I explain everything in detail. You see it now. So I said the third thing to do is to check the orientation of the market, and we do that on the monthly. The next thing we have to do is to go to the daily. We want to look at the structure and the tide. Do you see how we analyze the market? Check the weekly, what is the directional bias? Check the monthly, what is the orientation of the market? Check the daily, what is the structure and the tide of the market? The structure and the tide of the market is checked on the daily chart. So after you check that on the daily chart and you are able to identify an impulsive move on the daily, it means you can now position for a trade on the 4 hours and on the 1 hour. Do you see that now? So I want this to load. The internet is a bit not friendly over here, so that is why it's taking time before this can load. And of course, this was the reason why we could not record, we could not do our live session. So once we get to the daily, we look at the tide. The tide is on the daily is the price above the cloud on the daily. That is the tide. If the price is above the cloud on the daily, it means that the tide is a buy. And the tide is expected to be in alignment with the directional bias. Are you getting it now? So we have the structure on the daily to now align with the tide. We have a bullish structure now. Why? Because we have a break of structure to the upside. This was what we were waiting for last week. So now on the daily, we have confirmed that the structure is a buy because we have this break of structure and we have been able to identify this particular impulsive move. You see it now. So it means that what we are waiting for is a corrective move. Then we are going to move to the upside. We are expecting gold to move on the average to this region. So gold should buy between now and the next 2 weeks, plus or minus. Gold should buy between now and the next 2 weeks into this particular resistance zone. All other things held constant. Resistance zone, it means we are expecting gold to come to 5,550 on the minimum. 5,550 on the minimum on gold. So on gold, we will still stay put. We go to the 4 hours. On the 4 hours, we expect the tide to still be a buy, which means that the price will still be above the cloud. You see it now. You see that the price is still above the cloud. This is where we are coming. But how do we get here? I'm going to show you now. Because on this particular gold trade, we have four out of our 7 conditions are already met. So we expect this particular market to come here, break this structure, then break up like this. Then we can now position for it around this place, then take it up. You see it now. This is where we'll be waiting for the market to come to, around this place. This is where we'll be waiting for the market. So the market will break this particular, this particular, yeah, we break this particular bearish structure to the downside. Once you see this on the 4 hours, and of course you are not to draw it, the structure tool will draw it for you. I just drew this because the market has not broken below this particular. So gold is going to break below this. We come to around maybe 5,100 or maybe 5,120, or thereabout. Then we expect it, we will still wait for it to break and give us a break of structure on the 4 hours. Do you see how we follow trade, systematically? And this is how we approach the market. Before we take any trade, we observe. We observe for days, for weeks. And that is not a guarantee that the trade will be a win trade. It's just our style of trading. And that means that we can do this from now till the next 30 years because we have a system. No emotion, no I feel like I think, or somebody said gold will buy and I just jump into gold and I'm buying. No, you want gold to buy and you want to jump the buy. When gold is ready to buy, you join the wave. That's how you trade. So because of time, I will just do one more asset. I will do one more asset and we'll call it a day. So let me pick one asset from our minor. I think on AUD JPY, almost 6 out of our conditions have been met. We have 7 conditions, plus or minus. 6 out of the conditions have been met. So let's start our analysis. Let me just clear the chart. Let's start our analysis afresh. Let's see what we have on AUD JPY. So remember, when you get to any asset, you have to remind yourself of what is the conclusion from the fundamental and the sentiment analysis. What is the condition of our risk sentiment overview of the market from the fundamental and the sentiment analysis? The conclusion is that we have risk on dollar aversion sentiment. So what that means, the implication of that for AUD JPY, anytime there is a risk on in the market, capital is expected to be flowing away from low yield currencies like the JPY and be flowing into high yield currency like the Australian dollar. You will remember that the interest rate for AUD happens to be 3.85, while the interest rate for JPY happens to be 0.75. If you compare these two currencies, the interest rate divergence happens to be the highest in the market. So AUD JPY, we are expecting that AUD JPY is going to give us a clean buy. You will notice that the market has been buying over time, and this is from the interest rate divergence standpoint. It's a fundamental movement. You see it now, it has been buying over time, and this is because AUD JPY has been maintaining interest rate that is very high as compared to the JPY. You see it now. So we expect this particular bullish move to continue. However, we don't just want to jump into the trade. We want to follow our trading rules systematically as if we are robots. So we look at the weekly chart. We expect the weekly chart to tell us the directional bias. If you can see my chart, you will notice that the price is above the cloud. That means that we are on a bi-directional bias. The next thing we do is to go to the monthly. What is the orientation of the market on the monthly? In fact, orientation of the market on the monthly, you don't need to worry yourself. If you have the tools plugged in, the market structure tools, you will see the structure on the monthly. You see that we have a change of character to the upside, a break of structure to the upside on the monthly. That is your orientation. You can see that you have a markup on the monthly. You don't need to struggle yourself, to struggle with the market. You have a markup on the on the monthly, and that is telling us that is an upward movement for AUDJPY even on the monthly. However, you cannot rely on the monthly to take position. So we want to go to the daily. What is happening on the daily? Do we have a structure that validates the directional bias and the orientation of the market? On the daily, we want to look at the tide also. The price must be above the cloud, and you will see it now that the price is already above the cloud. Can you see it now? Can you see it? Then what is the structure? You will notice that we had a change of character to the upside. Now it means we are ready to take position for AUDJPY. However, we want to move to the 4 hours chart. The 4 hours chart, we expect that we should have the price above the cloud, and the structure should still be a buy. You see it now that we have this particular, this is the impulsive wave, this is the break of structure. So I'm going to show you what we are expecting on AUDJPY now. This is how you can trade, so that the day you start trading big money, you will just trade with a relaxed mindset. You see it now. We expect AUDJPY to do something like this. So we are going to be positioning for a buy on AUDJPY. 6 out of our 7 conditions have been met. So plus or minus, we'll be expecting AUDJPY to either move into this liquidity zone or create an unblocked liquidity zone below this particular low. If this particular candle closes by 3 p.m., then you now move to 1 hour chart. You see how we analyze the market? You don't rush yourself. So this is what you are expecting on AUDJPY. Once the market creates a break of structure on the 1 hour chart, you will notice that everything is happening above the cloud. Everything, if you want to take a buy in the market, everything must be happening above the cloud, from the 1 hour chart to the 4 hour chart to the daily chart to the weekly chart. And the monthly chart must be telling you that there is either a markup, a markdown to validate the position you want to take. Are you getting it now? So on this particular 1 hour chart, we are expecting that if this particular trade comes like this and maybe break a structure like this, something like this, down to the downside, it will now create a break of structure here. You see this break of structure, or if it doesn't do that, we are expecting that this particular trade should move into this particular liquidity zone. All we are expecting is that we want the price to come to the liquidity zone. That is where we can see enough of movement. And once it gets there, it should give us an engulfing move. That is when we will now position for the trade. All this analysis is to just ensure that we are trading with a system. It's not emotion. So if we are going to enter 20 trade, we are going to enter the 20 trade using this particular strategy. We are not going to be imagining, or we'll be projecting, or we'll be assuming, or we'll be hoping. There's no hoping. That is how we trade at Potential Miners International. I want to really encourage you, if you are seeing this video for the first time, it might not be the conventional video that you see around, where people just come up with one thing just to catch your attention and they go, and it's not really changing your trading experience. What we are trying to do is to ensure that we build community of traders that can really sit down and understand how the market works, and they can build the skills over time, and they can now consistently make money from the forex market. For us at Potential Miners International, this is a long journey. It took us over 6 years to get, to harmonize all this, our discovery. And now we have started the journey, and we are hoping that we can build community of professional traders that will trade alongside with us. And that is why you will see us every now and then coming up with videos that can really help your trading journey. And I want to encourage you to subscribe to this channel and turn on the notification bell If possible, share the video, our videos, with your friend, your colleagues, and tell them that there is a way you can trade in the forex market and make consistent money for yourself. Until I see you in the next video, I remain Mr. Kimode, the king of waves. Thanks for listening. God bless you.